All right, hello everybody. Welcome in to our webinar here today. Thank you for taking time out of your day to join us for our options demo. We normally like to do these sessions in live market conditions, but with markets closed today with Good Friday, we're going to go ahead and review some of our trades here from this past week. We'll also give you some thoughts on some things that we're going to be looking at for next week's session, next week's trading. It's going to be a very active week. I anticipate going into next week. It's been a very active last 6 weeks or so, really, and I don't see that changing anytime soon. So a lot to talk about. It was a very active week for us this past week. A lot of trades, a lot of quick trades, in fact. With a big range in the markets, it's been a little bit of a challenge because there's so much going on, and we'll talk about that in more detail when we get over to the charts. Before we get to those charts, my name is Mike Rixey. I do run all of the options programs at NetPicks. I am a full-time options trader myself. I've been trading going back to 2002. I started out trading options. I have dabbled in some futures trading in the past, some day trading, but my primary focus here these days is on a swing trading approach with options. That's how I make a majority of my income. And I prefer the swing trading approach for a couple of different reasons. A lot of people like to trade options because you're working a full-time job, or you've got other commitments that take up a lot of your time. And that's a big part of it for me as well. But also what I have found is that just due to my personality, I tend to be a deep thinker. I tend to be a little bit slower in making quick decisions. The swing trading approach fits me better, and I tend to see better consistency. I was not a great day trader. I was very inconsistent because I found it difficult to pull the trigger very quickly. As a result, I missed a lot of trades, or I ended up getting into trades late, and it's just not a good formula for success. So at NetPicks, we do have systems that are specifically designed for day trading, and they work really well for a lot of people. But I'm also a big believer that there's no cookie cutter approach for everybody. I think a crucial piece to the puzzle for most people is finding that area, that niche that fits you best. For some people, it's going to be day trading. For others, it's going to be swing trading, or a combination of both. A lot of times people get so zoned in on one approach or one market, when in reality there might be a better approach out there for you that's going to give you better results. So just keep that in mind. If you're already trading options, great. If you're brand new, just trying to see, is this something you want to get into, add options to the mix, I think you'll see here today, it's a great way to approach the markets. Very little time commitment on a daily basis, and it's a great use of capital as well. You'll see on some of the trades that I'm going to walk through, we're talking about a couple $100s of capital at a minimum. So I just don't need a six-figure account to utilize these tools. So I like to start out most of my sessions here giving some general overall thoughts on the market. The reason I do this really shapes how I approach the markets in the coming days and weeks. What you'll see in a moment, with options, we have tremendous flexibility. Through position sizing, we can utilize different types of option strategies, different expiration cycles, to really make sure we're taking trades that fit our risk tolerance and also our outlook for the market. A big mistake that I see retail traders making these days is just jumping in with both feet, taking one or two extremely large positions and hoping for the best. When in reality, for me, I like to trade very, very small. I like to spread my capital across as many different areas as possible. And again, it's not something where I'm trading hundreds of products on a daily basis, but if I can start to implement different stocks and ETFs and different sectors, I'm going to see more consistency, and that's what we're all looking for. Before I get into the charts, if you have any questions at any point during the session today, feel free to type those in to the chat box, and I will go ahead and get to those as they come in. So I've got some tools that I like to use on a daily basis just to get a feel for the overall market environment. I do not use any type of financial media. I don't have CNBC on, I don't have Bloomberg on, Fox Business, none of it, because I don't want to get distracted. I want to base all of my decisions off of price action on the charts. Price action is king. It trumps everything. You start to listen to the talking heads on TV, you have to remember everybody has an agenda. They have an outlook for the market. I don't want to be impacted by what other people are doing. I want to be impacted by what's going on the charts. So the first tool that I use, this is what we call our market overview chart. It's just a simple daily chart of SPY. I've got a variety of different moving averages on here. Some very common ones, the 20, the 50, the 200 period moving averages. And then I also have some exponential moving averages on as well. I'm essentially looking for support and resistance levels. I'm looking to see, are we overbought or oversold, because I want to get a feel for how aggressive I want to be. Over time, we are going to have a mix of long and short trades, and we've had that just in the past couple of days. For me, long term, I tend to lean towards the bearish camp. I do think there's more downside to come in the coming months, but that does not mean I'm going to avoid the long side. Just in the last couple of days, we've had some great profits on the long trades, but I've taken those trades with smaller position sizes. I've taken many of them with long call spreads, and I've gone farther out in time to the monthly options. So it's a way for me to stay active on the long side, even though I'm slightly bearish going forward long term. It's one way for me to stay active, take what the market's giving me while making sure I'm in positions that I'm comfortable with the risk on. So looking at this daily chart, I'm seeing over the past 4 or 5 days, we have tested the 200 period moving averages, both the simple and the exponential. Those are the red lines here on the chart. We've tested them almost on a daily basis. So far, those levels have been rock solid. We really haven't even probed below those levels intraday. I mean, they've just been really strong areas of support. If those levels break going into next week, I do think we could see another quick wave to the downside. There's probably a lot of long-term stops that are sitting right below those levels. If those stops get run, we could see a pretty big move to the downside early next week. If those levels hold, you can see that they were tested back in early February, and we saw a significant bounce off of them, right? We could very well see that happen again going into next week. There's a lot of people that are starting to get short here. When you start to get into a downtrend, you can see some pretty vicious rallies. Short covering rallies, call it a V-shaped recovery, whatever you want to call it, they can get nasty on the upside. So we could very well see that going into next week. We already saw a little bit of it on Friday. You can see Friday's candle here. Pretty impressive. We did sell off going into the afternoon, so there was a little nervousness there going into a long weekend, which is understandable. We did find some resistance right on top of that pink line, which is the 8-period exponential moving average. So we're in a very interesting point going into next week. We're kind of pinned right inside of those support and resistance levels from last week. Those are the levels that I'm going to be watching next week. Now, I want to see support and resistance levels broken on a closing basis. Probing above or below those levels intraday, that's not enough for me. So I want to see those levels broken on a closing basis going into next week. I also keep a close eye on the volume number. Down at the bottom of that chart, you will see I've got the volume indicator on there along with a volume average, just looking at the past 50 sessions. That's that yellow line there on the volume indicator. We have been pretty solid above the 100 million share range over the past couple of weeks, and that's really where I want to be. That's the magic number for us. When we start to get above 100 million shares, it just becomes much easier for us to get filled on trades. The bid-ask spreads start to tighten in the options markets. We're able to get filled at better prices, which is definitely a good thing for us. If we start to drift back below that 80, 70 million share level, that's when it starts to become more difficult. That's what we saw most of 2017. That's why it was such a challenge last year. Not only was the market very slow, it was a challenge getting filled on trades. You had to give up some on the price quite a bit last year. I'm not necessarily seeing that as much to start the year, which is great. The volume increase that we've seen so far in the first quarter has been phenomenal. It's really helped us out. So I'd like to see that continue over the next couple of months. So based on my outlook on this chart, I do want to continue to be more aggressive on the downside and more conservative on the upside. So when I say more aggressive, when we take a look at the charts in just a second, if we have some short trades that are printing going into next week, I'm going to be looking at those with larger position sizes, more long puts as opposed to put spreads, and potentially I'm willing to trade some of the shorter term options. Those are all valid ways of getting more aggressive. I want to be cautious on the upside. I do think we could see a short covering rally, but I want to be more conservative because I'm not convinced that there's going to be a lot of continuation to the upside at this point. So being more conservative, smaller position sizes, more long call spreads, potentially going farther out in time, looking at some of the longer term monthly options. Those are all ways of getting into positions with a more conservative outlook. The reason I point this out, a lot of times people get so stuck in their opinion on what they think the market should do that it impacts their trading too much. Meaning if you're bearish like I am, a lot of times people will just say, hey, I'm going to avoid the upside altogether. I'm not going to take any long trades, or vice versa. Maybe you're bullish and you think the support levels are going to hold and the market's going to rally. So you don't take any short positions. For me, long term, I feel more comfortable having a mix of long and short trades. We can even throw in some more market neutral trades as well, which we'll talk about in just a bit. Having those good mix, the good mix of strategies and positions, that's going to give you the better equity curve long term. So for me, on my approach going into next week, I will be active on the downside if things roll back over, and I'm going to do so with a more aggressive strategy. On any upside moves that we get, any long trades, I will be slightly more conservative. All right, let's go over to the charts and let's talk through some of the trades that we closed out here last week. It was a very active stretch for us. Let's go ahead and let's talk about some of the trades from yesterday's session. Let's go into Facebook. Facebook has been all over the news here the last couple of weeks, and rightfully so. I mean, the news has been pretty awful. So the stock has been beat up. Okay, if I zoom out a little bit, so you can see a bigger picture view, I mean, you can see it's been a pretty nasty move to the downside. Now, inside of that move to the downside, you'll notice that we have had periods that we've had some pretty nice bounces, right? This bounce right here. We had a couple in here. We had another one on Thursday. So the reason I point this out, if you start to get impacted by the news and what everybody's talking about on Facebook, you're potentially missing out on some pretty phenomenal profit potential on these upside moves. Granted, when that move to the downside initially started, we actually took a short trade. Okay, let me get my data box up so we can take a look at the dates on this one. So this was a short trade from back on March 13th. That one ended up hitting full profit for us. The pink dots on the chart represent our short setups. They represent our entry point, which is right here. We had two targets down below and our stop up above. So now everything is outlined for us. There's no guesswork involved. We're limiting the emotional aspect of trading because now we have a framework that we can follow. So when that entry point is hit, I need to determine how aggressive do I want to be. That's why I look at that daily chart. That's why I look at some of the internals. So when the market is open, we take a look at the volume ratio. We take a look at the internals to see how strong or weak the market truly is. So when that short trade triggered in, I wanted to get more aggressive. I was bearish at that point, as I am now, so I took it with a long put. I took it with a bigger position size, and it clearly paid off. After taking some heat there for a couple of days, we were underwater for the first couple of days. We hadn't hit a stop yet. We hadn't hit a target yet, so there was no reason to close out of the position. We held on, and it was just a really good trade. I mean, within 24 hours, we went from a partial loss to a full profit. We had a big gap to the downside, and we booked the profit. Now, here's where it got a little challenging. If I don't have my system in place, okay, it's going to be very difficult for me to play the upside. Because I'm bearish on the market, because Facebook's starting to head lower, I would really rather play the downside, but the system wasn't giving me any short trades. We actually got a couple of long trades in here. Fast forward to March 20th, and we actually had a long trade. The tricky part about this one is the news was already out. Okay, Facebook was just getting beat up on the charts. It was getting beat up in all the headlines. Felt like the bottom was going to fall out a bit. And here the system actually gave me a long setup. The reason we got a long setup here is because the %R indicator down at the bottom was oversold. We got down below -90. We got to close above our signal line. That gave me my entry point. So when that entry point was hit, Facebook's on my watch list. It's a name that I trade day in and day out. All of my criteria was met for a long setup. I had to take the position, even though I was bearish on the overall market. So I took it with a little bit more conservative position. I took it with a smaller position size. I went out to the monthly options. The farther out in time that you go, the options are going to react slower to changes in stock price. We talk about the gamma risk in our training room all the time. If you want the higher directional risk, if you want the higher profit potential, the shorter term options are going to provide that for you. If you want to get more conservative, going out to the monthly options, it's still going to leave you with a directional trade. It's just not going to be as aggressive. So I went out to the monthly options, went with the long calls. You could have used the call spread as well. The nice part about a vertical spread, they typically reduce your cost by 30 to 50%, which is great. So I triggered into this long trade, and within 24 hours, I mean, you can see it did reverse. Let me zoom in a little bit to that so you can see it a little bit more detail here. Within 24 hours, we were immediately underwater. If I didn't have my system in place, chances are my emotions are taking over, and I'm saying, hey, the news is awful. All you're hearing about is Facebook, completely falling apart. I better get out of this position. Well, when I looked at this chart, I could see I never hit my stop. I hadn't hit a target yet. There was no reason for me to get out of the trade. Well, you can see patience paid off again. Fast forward a couple of hours, and we went from a partial loss to a full profit. We came up and we hit that full second target. So my discipline to the system, my patience paid off in a big way. Had I avoided that long trade because I was bearish, I would have left a lot of profit on the table. So the key with our system is what we classify as swing trade is holding a position for anywhere from 24 hours on out to 2 weeks. Most of our holding times are typically in the 2 to 5 day range. That's very typical for most of our trade plans. We've been near the shorter end of that range here over the past couple of weeks because the market's been wild and crazy on a daily basis. So the reason I point that out, I might be long-term bearish on this market going out the next couple of months, but in the near term, over the next couple of days, we could certainly see some of these rallies. On many of these positions, I don't need a 10% move on Facebook to make money. And this long setup, the entry point was at 166.55. My full target was up at 171.07. So I needed a $4 or $5 move to the upside on Facebook. Doesn't look like a huge move, but if you get a $4 or $5 move in the stock and you have a long call position on, you're going to see some really nice percentage returns. A lot of times our percentage returns are in the 50 to 150% range. Now, I took this with a more conservative trade. I would have had the higher percentage return had I gone with the shorter term option. So if I would have traded the weekly options, they would have provided more profit potential. I decided to go farther out in time with the monthly, so I gave up some of that profit potential. I had a lower return, which I am completely okay with because at the time that trade triggered in, I was taking a position that I was comfortable with. As traders, we can always look back and, hindsight's always 20/20. I can always look back and say, I should have done this and I should have done that. When that trade triggered in, I put on a position where the outcome of that one trade is not going to have any impact on my ability to take the next trade. I took it with a very small position size. Okay, win or lose, I'm still going to be able to take the next trade in the sequence. So that trade really paid off in a big way. Now, just looking at the timing of this trade, it triggered in on the 20th of March. We hit full target the very next day. So very short holding time. We're talking about less than 24 hours. That's one of the extremes that we've been seeing here lately. We've seen a lot of very short-term trades. It's not going to be the new norm long-term. But you have to look at what the overall market's been doing. We've been seeing 500, 600, 700 point ranges in the Dow. I mean, you're in that type of a range, you're going to have some pretty big moves. You're going to have some of those shorter term trades. Well, the system does a great job of adapting to those changing market conditions. We're utilizing a range-based chart here. So on Facebook, this is not an hourly chart. It's not a daily chart. This is what's known as a range-based chart. And I'll show you this here a second. The range that I'm using here is 119 ticks. So every candle represents $1.19 of price action from high to low. It has nothing to do with time. It could take 5 minutes for a candle to form. It could take 5 hours for a candle to form. Just depends on how active the market is. The crucial piece here, it allows us to react faster to changes in stock price. If you're using a daily chart in a market like this, you're potentially missing out on a lot of movement. Okay, but if we're seeing a 500, 600 point range in the market intraday, if you're waiting for a daily candle to close before you get in and out of a position, you're potentially just getting in late. You're going to miss out on so much of that price action. These range-based charts will allow us to react much faster. When there's a lot of price action, when there's big range, you're going to have a wider number or a bigger number of candles printing on your chart. As markets slow down, you're going to see fewer candles on your chart. So the system is going to self-adjust to the changing market conditions. That's a huge advantage. Now, where did I come up with that number? The 119 number? There's a formula that we look at once a quarter, and it tells us the exact range setting that we should be using on every stock on our list. And that makes sense when you think about it, because Facebook moves completely different than Amazon. Amazon moves completely different than Bank of America. So every name that we trade has a different personality. I can't just use the same chart settings on Amazon and expect them to work on Bank of America, because they're such different products. So by fine-tuning the system, using that formula once a quarter, we're really able to dial in those setups to the current conditions for every stock on our list. It's a big difference between this system and others out there. There's not a lot of people utilizing this approach, and that's why it's a huge advantage to what we do. Now, if I scroll forward, you can see here last week we had a couple of nice winning long trades. The first two were from earlier in the week. These were actually trades that only hit the first target. You can see on this original long trade right here, back from the 26th, we triggered long, we came up and hit first target, and that's where price action stalled out. Unfortunately, we did not come up and hit that full target. However, using our smart money management rules that we built into the system, as soon as that first target is hit, notice the system moves the stop to break even. It moves it up to the entry point. We're taking the risk off the table at that point. Right, so we took the trade off, and the same situation repeated itself on the next long trade. It only hit that first target before stalling out. Okay, now let's take a look at the setup from yesterday's session, from Thursday. This setup actually printed for us on Wednesday. It started printing on Wednesday. We had the long setup, the long dots right there. It did not trigger in until yesterday morning. So we had, in most setups, we have a period of hours or even days before the trade triggers in. It's not something where you have to sit there all day long just staring at the charts. So in this case, we put the position on yesterday morning, and this one actually hit target same day. We saw a very significant rally midday yesterday on just about every name on our list, especially these names that got a little overdone on the downside over the past week and a half. So many of the tech names decided to finally bounce up off of their lows. So this was actually a day trade. It's not the design of the system to have day trades like this. It's definitely the exception rather than the rule. But when you have a market that's this active, this is volatile, you're going to have situations like this from time to time. So we closed out of the position yesterday. Again, it was a smaller winner for me. I continue to be more cautious, more conservative on the upside. So going out to the monthly options, taking a smaller position size, as a result of that, I left a little bit of profit on the table. It was still a nice winner. I took a trade that I was comfortable with as far as the risk goes, so I'm not going to complain about it. It was just a really nice trade for us. But I'm going to continue to take this approach. I'm going to continue to be conservative on the upside, more aggressive on the downside. So now going into next week, what do? Markets closed here today. When we come back on Monday, down at the bottom, the %R indicator drives everything that I do. I'm looking for overbought or oversold conditions. We had that nice move to the upside yesterday, but it was not enough to get us above -10. We did not get overbought yesterday, so there's nothing for me to do here. And that's the key. I don't need to be in the market all the time on every product on my list. I'm looking for the very best opportunities. I'm not going to try to force a trade on Facebook if there's nothing setting up there. So the nice part about having the calculator there that prints the setups for us on the charts in real time, going into Monday's session, if I don't see any new blue or pink dots on the chart, there's no setup there. I don't need to look at it all day long. I'm going to wait for the next setup to appear. So for that to happen, I need either a move above -10 to give me an overbought condition, or below -90. That would give me an oversold condition. Until one of those two events happen, there's nothing for me to do on Facebook. That's why it's perfect to have a bigger watch list of products. If all you're going to do is trade Facebook, well, if there's nothing to do on Monday, it's going to be a pretty dull session. Most of our students have a watch list of between 12 and 20 products. I personally look at 28 markets on a daily basis. So even though I'm flat on Facebook, I don't need to feel like I have to force something, because there's plenty of other markets out there that I can go ahead and trade. In fact, let's go ahead and take a look at some of those right now. Let's take a look at going to try to find one that triggered in, and well, let's take a look at Goldman Sachs here, symbol GS. This was a trade that triggered in on Wednesday, triggered long, so we had an oversold condition on %R. I had a close above the signal line. It gave me my entry point. That was that first blue dot right here. So I triggered into that trade, and as soon as I get into that trade, I know where my targets are at. The two target levels up above, 252.84 and 255.60. The stop was initially down below all the way at 244.37. Notice what happened yesterday on that rally to the upside. We came up and we hit that first target. That did a couple of things for me. If I'm trading multiple contracts or multiple spreads, I can close out of half of the trade there if I wanted to and book the profit. At the very minimum, I'm going to move the stop up to the entry point. So my stop has been moved up from the full level to break even to the 249.30 level. So going into Monday's session, my plan is already laid out for me on Goldman Sachs. I still have half of my trade on, which I'm targeting 255.60 all the way up here. Worst case, let's say something happens over the long weekend, the markets decide to open lower. Worst case, I'm out at that entry point. I'm out at break even. And I've already locked in a little bit of profit on the first half of my trade. So we're really in a perfect situation. Not only have we booked a little bit of profit here, but it just cuts down on the amount of time that's required over the weekend to generate my plan for next week. I don't have to sit there and stress Monday morning because everything's outlined for me on Goldman Sachs. I'll place some price alerts around my target level, around my stop level, and until one of those levels are hit, there's nothing for me to do. I just continue to track the trade until it completes. You know, I'm a big Twitter user. I like to follow a lot of different traders on Twitter, and more for entertainment purposes than anything. You know, I'm not looking for, you know, trading advice or trading ideas. I'm just looking to see what other people are doing, and it amazes me how many people spend literally hours every weekend trying to generate their plan for next week. And for me, I spend enough time during the week, Monday through Friday. I mean, especially in this type of a market environment, I spend enough time in front of the charts. The last thing I want to do is be stuck in front of the charts when the market's not even open on Saturday and Sunday, or in this case on Friday when the market's closed. So having that system in place where I know long-term the numbers are in my favor. I'm going to have winners, losers, and break-evens. Okay, I had all of those just this past week. But because I know the odds are in my favor long-term, all I have to do is execute my system correctly. All I have to do is follow that roadmap on the chart, and it just really limits the amount of time that's required to look at the charts. It's perfect for those that are, you know, working a part or full-time job, or, you know, somebody that just has other commitments that you just don't want to be stuck in front of the screen all day long. This is the perfect approach. So Goldman Sachs, I am long going into next week with half of my position looking for one more push to the upside. Let's take a look at American Airlines here. We actually held a couple of sales webinars here yesterday, so if any of you were in on those webinars, you heard me talk about this one in more detail. This is the last short trade that we closed out. So again, the pink dots on the chart represent the entries, the targets, and the stops on the short side. We came in and we bought the April 60 puts, and this trade initially set up for us on the 14th of March. It triggered in that very same day. Okay, within the next hour or two from setting up, it had triggered in for us. Now, before I talk through the results of this trade, notice what happened over the next couple of days. Price action just chopped sideways. We never really broke to the downside, right? So a lot of times people ask, well, what if I'm not there at the chart at the very moment that that trade triggers in? Okay, because it triggered in pretty quickly that same day. We have what we call our get in sync rules. And those rules state as long as the first target or the stop have not been hit and price action gets back to the entry point, you can still grab the trade. And I use these rules all the time because of my busy schedule. I can't look at the charts all day. Notice what happened over the next 2-3 days. We never hit first target. We never hit stop, and price action during that whole stretch was right at the entry point. There was a stretch there of almost 3 full days that you could still jump in and grab that trade. Will we have the trades that will occasionally trigger in and go right to stop or target? Sure, that'll certainly happen from time to time, but more often than not, you're going to see a situation like this where you have multiple opportunities to catch the trade over a period of hours or days. So just again, it's another way for us to free up our schedule and not be glued to the screens all day long. So after a couple days of chopping around, we did come down, we hit first target. So if you're trading multiple contracts, we can close out of half of the trade there, book the partial profit. At the very minimum, we're going to move the stop from the full level up here to break even, down to the entry point, which is exactly what we did. Fortunately for us, we never hit that stop. And the very next day, we came down and we hit the full target. So we closed out of that position, booked a $238 profit, it was a 53% return. So a little bit smaller on the percentage return side of things than what we normally see, but that was because I got more conservative. I went with the April monthly options. Had I gone with the weekly options here, you're probably looking at 100 to 125% return. But because I was a little bit more conservative, it still was a great return. I'm not going to complain about a 53% return in what, 4 days, 4 or 5 trading days. I mean, we'll take that every time. Especially considering, you know, it only took me 20 minutes a day to come in and check my charts. I come in once in the morning around the market open, once around lunch, and once in the afternoon. Typically takes me about 5 to 10 minutes each time I come in, just depending on how active the market is. So I come in a couple times just to check things. Am I missing any new setups? Are we approaching any target or stop levels? Other than that, I move on. I get other things done throughout the day, and not only does that help me get to other things, it also helps limit the emotional aspect of trading. I'm not going to get stuck overreacting to every little move back and forth like it's happened to me in the past. I'm going to focus in on executing my system correctly and moving on to other things throughout the day. So it's a win-win situation. So it was a really nice trade. Notice what happened over the next couple of days. We continue to move to the downside. So a lot of times people look at the situation and say, well, why'd you get out at the full second target? Had you held on longer, you would have been facing even a larger profit. Well, that's certainly true, but there's a couple things you have to keep in mind. Number one, we're in an extreme market environment right now. We're seeing a lot of big moves. That's not the norm long term. Those targets are there for a reason. They're there based off of what the range has been over the previous number of months on American Airlines. So when that second target is hit, I'm going to book the profit. I'm not going to keep any of my position on using a trailing stop and go for the home run trades because I can't prove it statistically that it happens often enough to be worth my while. If I buy a long put like I did here, I have to remember the longer I hold that trade, the more the time decay hurts me. So if I hold on too long and we don't get a move to the downside, what if price action decided to bounce to the upside? I'm giving up some of the profit because price action has reversed against me, but I'm also losing potential profit because the time decay is adding up. So I've got to keep that in mind. If I can prove it statistically long term that it does work out in our favor to go for the bigger winners, I will certainly do so. I track it all the time, but just long term over months and months worth of trades, I can't prove it. It just doesn't work out in your benefit often enough. So for me, I like to get out of my entire position at that second target. Now we did have a long trade that triggered in here yesterday. So again, this is just like we talked about on Facebook. I'm not really that thrilled with getting aggressive on the long side, but we got oversold. In the near term, over the next couple of days, the next week or two, we're probably a little overdone. We're probably going to see many of these names try to bounce, and they already tried to do so yesterday. So we had to move below -90 on %R. We had to close above the signal line. That gave us the entry point at the first series of blue dots, and the entry was hit. So we knew yesterday it's time to come in, put on some type of a bullish position. You don't have to get really aggressive, right? You can certainly go with a monthly long call option, or maybe you go with a call spread. Either one of those is a valid approach. Okay, so I'm personally in the long calls out in the April monthly options. My targets are up at 53.12 and 53.81. The stop's down at 49.5. So with that entry point at 51.55, let me take you over to the trade page here a second. Let's talk about how we identify the proper option to take the trades with. So let me go over to the trade page here and take a look at American Airlines. I am still trading the April monthly options. They have 21 days left. Going into next week, once we get through this long weekend, going into next week, we are going to be well below that 20-day left before expiration number. And for me, once I start to get below 20 days, those options really start to get more aggressive. The time decay is going to pick up. the gamma, which is the directional risk, starts to pick up. So if I'm going to trade those shorter term options, I have to have a very strong directional outlook for the market. Well, if we really don't see things break to the downside, if we start to see things kind of drift back higher, I'm going to start to transition farther out in time. I'm going to start to consider the May monthly options here at some point next week. For the meantime, I am continuing to trade the April. So that's exactly what I did when this trade triggered in yesterday. So with our entry point at 51.55, I went to the April monthly options. You take a look at these and you'll see that they've got 50-cent wide strikes, which is ideal. Makes it a lot easier for us to structure the trade. So when that trade triggered in, the 51.5 call, which I've highlighted there, that was the at the money call option. We like to trade the in the money options. When I'm buying an option, I like to trade the in the money options. It's one way of building in another layer of safety. The in the money options have less time decay. It's just a safer position. It gives you a higher probability of success. A lot of times people go to the cheap out of the money options because there's a lower cost and they think it's a less risky trade. Well, it's a cheaper cost, but that doesn't necessarily make it a less risky trade. Because when you start to go out of the money, that entire option, the entire value is all time decay. It's all extrinsic value. So in order for that trade to work out, you need a pretty big directional move, and it has to happen quickly in your favor. Otherwise, that thing is going to lose value very quickly. One way of getting more conservative is going in the money. Even though you're going to pay more for those in the money options, they are going to increase your odds of success. So what we teach our students is we like to be 1 to 2 strikes in the money from the entry point on our chart. So we identified the 51.5 call as the at the money call. The 51 call is 1 strike in the money. The 50.5 call is 2 strikes in the money. Now the reason we give you a little bit of leeway there is we want to take a look at the options liquidity. If I'm trying to decide, do I go 1 or 2 strikes in the money, is there an option here that very clearly has more activity? Well, the 51 call has 200 contracts of open interest and 40 of those contracts traded yesterday. The 50.5 call had 486 contracts of open interest and 213 traded yesterday. So just based on liquidity alone, the 50.5 call had way more activity there. There's way more going on. The higher the volume in open interest, the easier it's going to be for you to get filled quickly and at a good price. So I went with the 50.5 call here. That's the position that I have on going into next week. It's currently trading for around $2.50. If I go back over to the chart, you'll see that we've already moved past the entry point. So we're already up a little bit of money on this. So we got in at a little bit cheaper price point, a little bit closer to that $2 level, which is just over $200 per contract, just to give you the total cost on the trade. So now going back over to the chart, everything is outlined for me going into Monday's session. I've already put price alerts in place. I've identified my price alerts just in front of the first target, just in front of the stop. I got those in place yesterday over on my trading computer. So that's already been done. I'm good to go for Monday. I don't need to spend a ton of time over the weekend. Everything is ready for me to go come Monday morning. I know exactly where to get out if a target or a stop is hit. So really nice trade there on American Airlines. Without going into as much detail, let me go to, let's take a look at Caterpillar here. Caterpillar is another one that did trigger into a long trade yesterday, already hit first target. So this is another one where, we're already booking profit on half of our position, moving the stop up to break even. So going into Monday's session, worst case scenario, I've already booked a little bit of profit here and my stop's at break even. Really nice position to be in. It's sometimes going into a long weekend, it can be a little uncertain holding a lot of positions over the weekend, but a lot of these have already hit some target levels. It takes a lot of the stress off of the trades. So really good to have that happen here yesterday. Let me circle back to a long trade here. This was back from the 19th. This one triggered in again on the long side. 153.14 was that entry point. And let me see if I can zoom out a little bit so we can see the details of the trade. So we came in, we purchased the April 150 calls, $630 per contract, so a little bit more expensive because at that time I was going out to the monthly options. They had a little bit more time left to expiration, so they were a little bit more expensive. I was fine with that because I wanted the more conservative trade. I wanted the slower responding options by going out to the monthlies. This one came up, and within a couple of days, I mean, we triggered in here the morning of the 20th. Actually, the very next session, midday, we hit full target. $265 profit, 42% return. A little bit smaller percentage return because I went farther out in time and I got more conservative, but it was still, I mean, a 42% return in a couple of days. I mean, I love that. It's exactly why I love to trade these options. Most of our winning trades are in the 50 to 150% range, which anything inside of that range I'm thrilled with. If we start to get more aggressive over the next couple of weeks, if we say, hey, the volatility's been good, the market's been moving very quickly, let's roll the dice with the weekly options, we can certainly do that and potentially have some of the higher returns, the higher percentage returns. We just have to understand if we take that approach, it's also going to come with more risk. It's a higher risk, higher reward type of scenario. So it just depends on your outlook for the market. Now let's go over and take a look, because as much as I like to buy calls and puts, and that's a big part of what I do on a regular basis, they give us the really nice returns. The problem with those trades that we just got done talking about, if I bought a call on Goldman Sachs or buying the call on American Airlines, the only way I make money on those trades is if it makes a big move to the upside and it does so quickly. If it doesn't, if it starts to chop sideways, if it starts to move lower, I'm in trouble on that long call position. So they are definitely higher risk, higher reward type of scenarios. But our system identifies market direction well enough. You can already see just on the handful of trades that we've talked about from the last few days, it picks direction well enough to where I feel comfortable with a portion of my portfolio getting aggressive with those directional trades. But there's also times where I want to sell options. I want to sell some spreads because by selling a spread, I'm able to put some time decay in my favor. There's a lot of people out there that fall into one of those camps exclusively. They either believe in only buying options or only selling options. I am not part of that group. I like a mix of both. I like to take what the market's given us. The more diversification that we get into our trading, not only with the products that we trade, but with the strategies that we use, the better your overall equity curve will be long term. I've had stretches over the past few months where my long premium trades have been awful. They're just kind of chopping sideways. Even the trades that are winning, they're very small winners. But during that time, the short premium trades have been hitting it out of the park. I've seen stretches in the past where the exact opposite is true. Now, the ideal scenario, it's like we've seen here lately where everything is working. I mean, that's the perfect scenario, and that's the nice part about being in a market that's very active right now. So what we did here, let's take a look at some of our short premium trades. And these were all trades that we sent out to our students. We have a service called our Options Express program. We actually send these out through text message, through email, and we also post them in our private Slack group. The Slack is a program that you can put on your mobile platform or on your computer. It allows us to communicate with you back and forth in a private group setting. So what we did is we looked at Netflix. This was back when Netflix was right up at the all-time high. I mean, it was just moving higher every single day. We got very overbought. We also started to notice that the volatility started to creep up. The market started to get a little nervous that the move to the upside was not necessarily sustainable for much longer. Well, expecting the market to move lower, I could have bought a long put. The problem with that is I only make money again if Netflix makes a big move to the downside immediately. I wasn't necessarily convinced that that was going to happen immediately. So we came in and we sold the 337.5, 340 call spread, and we collected 82 cents. So we sold the 337.5 call. We bought the 340 call to make it a risk-defined trade just so we can keep our risk at a manageable level, and we collected 82 cents. The $82 that we collected to put the trade on is the most we can make on the trade, regardless of what happens on Netflix. So it is a bearish position. If Netflix falls out of bed like it has, the most I can make on that trade was 82 bucks, which doesn't look like it's, is that even worth your time? I mean, I've had comments come in like that from people. because you forget that look at the amount of capital that was required to put that trade on, $168 of capital. This was a $300 stock. You're talking about less than $200 of capital to control 100 shares. So, if you're trading one contract, that's fine. You can stay active in Netflix for as little as $168. But if you have a bigger account size, you can put this thing on 10 times, right? And you're talking about less than $1,700 of risk. Put it on 10 times and all of a sudden you've got $820 of profit. Here's why I love these trades so much. I drew the break-even point at 338.32. Okay, it's going ahead and taking a look at where's my break-even point? Where does it have to stay at for me to make money? Netflix had to stay below 338.32, which it was when I put this trade on. It was right in this area right here. If it went higher, slightly, I was okay. If it moved lower, I'm fine with that. If it moves sideways, I'm okay. I can profit in all three of those market scenarios. I make money from time decay adding up and from volatility decreasing. I have 5 different ways of making money on the trade. So my probability of success really starts to skyrocket. The long puts are going to give me more profit potential, but they have a lower probability of success. The short call spread here is still a bearish position, gives me a lower profit potential, but a higher probability of success. So now based on our outlook for the market, based on how aggressive we want to be, we have strategies that we can use to make sure we're in positions that fit our outlook for the market. They're all risk-defined trades. A lot of times people get intimidated by selling options because they think they're really risky. My maximum loss in this trade is $168. I can't lose any more than that regardless of what happens on Netflix. It's actually a safer trade than just buying an outright call or a put. Now, fortunately for us, this trade did work out. It did move to the downside. We booked the entire $82 profit. The whole thing expired worthless. I didn't have to pay the commission to close out of the trade. I close it out, book my profit, and move on to the next position. So now we're starting to mix in some different trade types. Let's actually take a look at a trade that we put on here last week. Let's go ahead and take a look at Twitter. It's actually, I think it was about a week and a half ago now that we did this. So what we did on Twitter, we came in, and Twitter, like the rest of the market, it's seen some pretty big swings back and forth. It's been pretty active. Well, looking at the charts, I really didn't have a strong directional bias. At the time that this trade triggered in for us, I really didn't have a strong opinion on whether it was going to move higher or lower in a big way. I also noticed that the volatility was pretty elevated. Looking at the statistics down at the bottom of the trade page, you can see that the IV percentile on Twitter was at 63. Anytime that the IV percentile is above 50, it's telling me that the prices of the options are more expensive. Anytime I see that happen, it piques my interest that, hey, there might be an opportunity to sell premium. If the options are more expensive, there's more premium for me to collect, which in return can give me a better profile on the trade, better risk to reward type of scenario. Okay, so what I did is I went out to the April monthly options. So again, these are the options with 21 days left. And I didn't want to do that. I wanted to go to Twitter. Okay, so let's take a look at the April options. We decided to sell an iron condor. Now, if you never go on to these advanced strategies, can you make it buying calls and puts? You can. You're going to have bigger swings in your equity curve. So one way to smoothen that out is to go ahead and use the vertical spreads. Whether you're buying a vertical spread or like we just talked about on Netflix where you're selling a vertical spread, that's one way where you can really start to get some more diversification and see more consistency in your returns. The next step in the process, which is, again, is completely optional, but it's something that I love to do, is to have some more market neutral trades in the mix. Selling an iron condor is a neutral trade where we're expecting that stock to stay inside of a range. It's what we call our profit window. So instead of trying to pick whether it's going to move higher or lower, we're trying to set up a window that price has to stay inside of. And if it does, even if it moves dead sideways and doesn't do anything, I can still generate some income. So what we did on this trade, we sold the 34 and a half calls spread. I was trying to make sure I had the strikes right here. So I'm going to right click on the 33 and a half call, go to sell and go to iron condor. We sold the 34 and a half call spread And then on the downside, we sold the 29.28 put spread. When we originally put this trade on, we were expecting Twitter to stay inside of a range. We were expecting it to stay pretty quiet. Well, that was a week and a half ago. I mean, a lot has changed since then, right? I mean, we've had some pretty big swings back and forth, so I was dead wrong on direction. I was expecting choppiness, and we've had anything but. Well, the cool part about this trade, we sold it. We put this trade on for 52 cents. So we collected 52 cents up front to put this trade on. Look at what this trade is trading at now. It's pricing at 53 cents. I'm down 1 penny. I have been dead wrong on what I expected the stock to do, and I'm down 1 penny. If we get any type of a move to the upside here over the next week or two, all I have to have happen here is for Twitter to stay up above 28.5. If it stays up above 28.50, I start to make money. I make money from time decay adding up. I make money from volatility decreasing. So let's move this price to 52 cents. That's where I got filled at here a week and a half ago. Let's go ahead and take a look at the profile. So my break-even points are at 28.48 and 34.02. So I mentioned I said, I said Twitter had to close above 28.50. It's actually 28.48. So that break-even point is calculated by taking my short put strike, which is the 29 put, and I'm subtracting 52 cents. That puts my break-even point at 28.48. On the upside, it's taking my short call strike, which is at 33.5. I'm adding in 52 cents there, and it puts my break-even point at 34.02. Those two numbers, those define my profit window. As long as Twitter stays inside of that range, I'm okay. I make money. So again, we're near the lower end. We're at 29.01. We're approaching my break-even point on the downside. We're still okay. If we stay right here and don't do a thing, I can still make money. I'll start to see that time decay add up in my favor. So the beauty of these trades, it's not something I want to do exclusively. I don't want to just, throw everything I have into iron condors, but to have a different trade type on here where you can be dead wrong on what you think the stock is going to do and still make money, I mean, that's the ideal scenario for us. The iron condor is never going to be a home run potential type of a trade. You're never going to come in and see 150% return on an iron condor. This is a trade that will allow you to stay active, generate a little bit of income from a sideways choppy type of a move, which I fully expect to happen here going forward. I mean, we've had a stretch of an incredible volatility. What we've seen historically is coming off of a volatile move. We're going to see a stretch where some of these names get choppy. And we're going to want to have that iron condor as a strategy that we can go to. So collecting 52 cents to put this trade on, the $52 is the most we can make on the trade. It's our max profit potential, which doesn't seem like a lot, but look at what it costs to put this trade on. It only tied up $48 of capital. That's the most we can lose on the trade. A lot of these short premium trades, we're talking about well under a couple $100. In this case, we're talking about less than $50 of capital that's required to put this trade on. You can put this thing on 10 times and have less than $500 of risk. You put it on 10 times, you've got a little over $500 of profit potential. You can generate $500 of income there from Twitter just staying inside of a wide range. It's just got to stay inside of a $6 range. If it does, I make that money. I get to keep that premium. Normally on our iron condors, we're right around a risk 1 to make 1 type of scenario, just like we are looking at here. On a short premium trade, it's not uncommon. If I just sell a call or a put spread, it's not uncommon for us to be in a risk 2 or risk 3 to make 1 type of scenario. The reason I'm willing to accept that bad risk to reward ratio is we have so many ways of making money on the trade. We already mentioned it earlier. We have 5 different ways of making money whenever we sell premium. On Twitter, we can make money if it moves up, down, or sideways, as long as it stays inside of our profit window. I make money from time decay adding up and from volatility decreasing. So I give myself multiple ways of making money on the trade, and as a result, I'm willing to sacrifice that risk to reward scenario. It's great when you buy a long call or a long put. If you can have your winners, 2, 3 times the size of your losers, that's phenomenal. But you've got to remember, you only have one way of making money on that trade. So that risk reward scenario, which is great in your favor, it comes at a cost. Right? You have to have everything work out in your favor. The timing's got to be perfect on that trade to make that phenomenal return. I'm not always convinced on the exact timing of the market. So again, by adding in the different types of trades, that's what's going to give you the consistency that's lacking for many people. Looking at my overall portfolio right now, I do have some long calls on. I've got some long puts. I've got some vertical spreads on. I've got some short call spreads. Got some short put spreads. I have some iron condors on. I've got a really good mix of strategies. A lot of times people say, well, you can do that because you're probably working with a larger account size than most people. Well, take a look at this trade here, this iron condor. We're talking about less than 50 bucks to put on an iron condor. The Netflix trade that we talked about a few moments ago, we're talking about less than 170 bucks per spread. A lot of these trades can be taken with a very small amount of capital. So now all of a sudden you can get on 7, 8, 9, 10 trades, and you're still talking about, you know, less than, well, depending on the products that you're trading, you're talking about a few $1,000s worth of capital at risk. You can do this with a small account size, and you can do this in 20 minutes a day or less. You're going to see far better results if you start to branch out into other different types of markets and trade types. Keith, just stating, I'm not at the level of trading options yet. Well, here's the beauty, Keith. Neither was I years ago when I first started. A lot of times people shy away from options because they seem overly complex, right? I mean, there just seems like there's a lot going on. I mean, you might not understand, what the heck is an iron condor? What is a vertical spread? It's, you know, like anything else that's new, there's going to be a learning curve. I'm not trying to sell you anything here today, so you're not going to hear a sales pitch from me, but that's why we designed our programs, right? We're going to walk you through the exact criteria that we look for when setting up this iron condor. We're going to teach you the terms and definitions. That way you can really put it into practice on your own going forward. You know, you start to take a look at this profit potential that is there. You know, is it worth your time, you know, to spend the next couple of months really learning about trading options? You know, when you can set yourself up for a year's worth of success, whether it be to, you know, a supplemental income or, you know, potentially to replace an income, it's certainly going to be in your best interest to do so. The problem that a lot of people face, and I deal with this on a daily basis with students, society is moving at such a fast pace these days, whether it be learning to trade options or anything else in life. Everybody wants things yesterday, right? They want immediate results. No one wants to put any type of effort into it. They just want, you know, they want to buy that app, put on their phone, turn the app on, and just, you know, watch everything happen. And I say that because I'm guilty of that myself. You know, with technology where it's at today, you know, there's so many things that are easy. But when you start to take a look at this, you know, when I'm starting to take a look at the big picture, you know, if I can spend a couple weeks, a couple months really diving in to learning my craft, to learning how to trade options, when you're starting to talk about, you know, thousands of dollars of profit here, it's certainly well worth your time and effort. What you don't want to do is get overwhelmed. You know, at some point in your training, you are going to be overwhelmed. I remember when I started trading in 2002, there was numerous times where I gave up for a couple of months because I was so overwhelmed I didn't know what to do. I had no one there holding my hand. I was just trying to figure it all out on my own. School of hard knocks for sure. Well, had I given up on it, I'd be missing out right now on some of the best markets we've ever seen, and I'd be missing out on a job where I can work, I can trade from anywhere I have an internet connection. I don't even need a computer these days. I can work from my iPad or my iPhone anywhere I have an internet connection. I can track the markets and track my trades. Most likely be stuck, you know, working 70 hours a week, stuck in an office all day had I given up on it. So, you know, what I would do is, you know, whether it be our systems, our programs, you know, or any other program out there, what you want to do is invest in some type of an educational program. You want to have a system in place that's very rule-based. You know, the most successful people in the world, whether it be an athlete or a business owner, the most successful people are the ones that surround themselves with a team of people that can help them hold them accountable to their business plan, right, to their goals, their athletic goals, and they have that system in place. Trading is no different. If you don't have that system in place, you're going to get chewed up, especially in a market like we're seeing now. But if you have those rules, if you have that system in place, we know with our system, you're going to have winners, losers, and break-evens. I will say that right up front. but we also know we're going to win more than we lose, and long term our winners are going to be larger than our losers on a majority of our trades. That's the formula for success that you want to have going forward. And Keith, feel free if you'd like to connect for a phone call or send me some email with some questions. I am more than willing to do that. Yeah, I want to make sure that if you need some guidance on how to get started, we're certainly willing to do that. And what you'll notice at NetPicks is, you get us on the phone, and we're all traders first. I'm not a salesman. I'm not. I mean, I can sell the NetPicks systems because I'm using them in my own trading. You can probably tell from this presentation today, I'm not the slick salesman. I don't have the the funny stories. I'm not going to get you laughing. I can talk to you about what's working in the markets. I can teach you how to make money from the markets. Right? And that's why, at NetPicks, in order to work for them as a company, you've got to be a trader. I'm actively in the markets with my own money every single day with these same systems. So we're all putting our money where our mouths are at, and that's a huge selling point. So Keith, my email, I'll go ahead and get this into the chat for everybody. Feel free to send me an email. My email is mike@netpicks.com, so really simple. And feel free to contact me, and I can definitely help you get on the right track there. So circling back to the Twitter trade, what I'm going to do over the next 21 days, I don't need to sit there and track it all day long. All I need to do is come in periodically to see, okay, am I in between my break-even points? If price action stays in between 28.50 and 34, I'm okay. I get to make money from that type of trade. Just looking over a couple of additional trades. I know we're running out of time here, but let me just talk about a couple of other positions that I have on going into next week, and this is how easy it is to do my weekend recap. Here's Tesla. We triggered into a Tesla trade yesterday. Tesla's been completely beat up over the past week or two. Well, Tesla triggered in long at 264.61. My targets are up at 275.71 and 279.71. My stop's down at 246.85. So I know exactly where I'm going to get out of this trade going into next week. Hopefully it wins. I know there's been some bad news out here over the past 24 hours. So if this trade loses, well, if I hit that stop, I'm going to get out of the trade. I'll take a loss. I'm going to keep my loss as small as I possibly can. The outcome of this one trade is not going to impact my ability to take the next trade. It's just the next trade in the sequence for me. So I will continue to hold that one into next week. BABA is another trade, symbol BABA. It's another trade that triggered in yesterday. I know where my targets are at, up at 185.21 and 187.13. The stop's at 176.40. Everything is outlined for me there. I know exactly what I'm going to do going into next week. So, if I want to come in over the weekend or, come in Monday morning and spend 10 minutes just to make sure all of my alerts are in place, I can certainly do that, but it's not something I have to spend all weekend on. VXX, I had some questions in our webinar yesterday that I never got to on VXX. We have a short trade that triggered in. This one actually triggered in on Wednesday at 50.05. Well, we had some really nice progress made yesterday. We already hit first target, so we moved the stop down to break even. We closed out of half of the position. We almost hit that full target here yesterday afternoon. Full target's down at 47.01. The stop has, notice how the stop's been moved down. It's trailing the signal line at this point. So worst case scenario on the second half of the trade, we're out with a partial profit. Now, in fairness, let me zoom back out. This is coming off of the previous trade from earlier in the week that did not work. That was a stop out. That was a loss. There's no doubt about it. I mean, there's no way around it. No way to avoid it. It was a losing trade. What the key is, knowing how VXX typically trades, okay, if we hit full target here on Monday morning, if we open up lower on VXX, I'm going to have a winner and a loser. My winner is going to be larger than my loser. So I'm going to have a winner and a loser. I'm still going to be up money. I'm still going to make money. That's the crucial piece. That's the important part about having a system in place. Had I just avoided the stop here earlier in the week and said, well, I'm not going to respect that stop. I still like the trade. I'm going to hold on a little bit longer. Had I done that, I'd run the risk of letting a small loser turn into a catastrophic loser, where all of a sudden it's a full loss and it takes 2 or 3 winners to battle back from that one loser. I don't want to fall into that trap. I want to make sure long term that my winners are larger than the losers. So when that stop was hit, I got out of the trade. It's not fun. I don't like to take losses, but I know it's part of trading. I moved on to the next trade. I wasn't intimidated by that loss. So as soon as this short setup printed again on Wednesday, I just jumped back in. I took it with a small position size, took it with a size where the outcome of that one trade is not going to impact my ability to take the next trade. Just the next trade in the sequence for me. All I can do, I have no control over what the market's going to do next. All I can control is my risk and executing my system correctly. If I do that over time, the numbers are in my favor. The odds are in my favor long term. That's the crucial piece, and that's what we're providing here with the NetPicks products. Yeah, sure, not a problem, Keith. And again, you know, if you have some newbie questions, let me know. Again, I'm not going to sit there and try to, you know, sell you something on our first call. You know, if you're not ready, you know, to jump into a program, you just have some general questions, let me know. More than willing to connect to help out there. All right, guys, I'm going to start to wrap up here for the day. Again, I appreciate you all taking your time on a Friday where the market's closed. I know there's other things that you probably enjoy doing here at this point, so I'll let you get on to your long weekend. I mentioned I was not going to try to sell you anything here today. If you have any questions or would like more detail on our programs or how we approach the markets, feel free to send me an email, mike@netpicks.com. Be more than willing to connect and answer any questions you might have. Really enjoying the markets here at this point. They've just been super active. It's the ideal environment for what we do as options traders. So it's just a great time to get involved. All right, if there's any last minute questions, go ahead and get those in now. Otherwise, I am going to wrap up for the day. Enjoy your long weekend, everybody. And we'll be back in the office first thing Monday morning. So if there's any questions that we can help out with, certainly let us know. Enjoy the weekend, everybody, and we'll talk again soon.